The three economic pillars laid out in Trump's State of the Union address, housing, tariffs, and anti-fraud measures, appear to balance kitchen table concerns with fiscal discipline. In reality, they rest on gaping numerical holes and contradictions that cannot be reconciled. The core promises clash fundamentally with fiscal reality and market logic. Behind the glossy policy rollout lies a chasm of numbers, one that could ultimately deepen America's fiscal mess and economic volatility. The housing proposal is trapped in a numbers paradox, trying to both lower prices and preserve homeowner wealth. The median U.S. home price has climbed from $327,000 in 2019 to $405,000 today. Home equity accounts for 45% of the median homeowner's wealth, the single largest asset for most families. Mortgage rates have eased from 6.85% last February to 6.01%, boosting affordability for median-income households by $30,000 compared to a year ago. Yet the nation still faces a housing shortage of 4 million units. Trump opposes large-scale construction to stabilize prices, but economists argue that adding supply would only slow appreciation, not trigger a crash. Banning institutional investors from buying single-family homes would add just 1%–2% to for-sale inventory, while likely pushing rents higher. The reality: lower rates can improve affordability without cutting prices, but rates alone can't fill a 4 million unit gap. Long-term supply-side reform is unavoidable. The idea of replacing income taxes with tariffs hits a fiscal wall. The revenue gap is sixfold. Individual income taxes bring in over $2.5 trillion annually, roughly half of federal revenue. Before the Supreme Court ruling, tariff revenue for this fiscal year was projected at $420 billion. Even with the new 15% global levy, 2026 tariff intake would roughly match that, a fraction of income tax receipts. Push tariffs above 50%, and the theoretical peak tops out at $900 billion annually, with net real revenue closer to $370 billion. Barely 1/6 of income tax haul. The Tax Foundation estimates that to replace $2 trillion in income tax revenue, tariffs would need to average 69.9% with zero drop in imports, a near impossibility. More fundamentally, before the income tax was enacted in 1913, federal spending was just 2% of GDP. Today, it's 22.7%. Tariffs simply cannot fund a modern state. High tariffs invite retaliation, fuel inflation, and ultimately choke growth, shrinking the very tax base they're meant to replace. The pitch to balance the budget by cracking down on fraud is a mismatch in magnitudes. The Government Accountability Office estimates annual federal fraud losses at $520 billion. The annual deficit? Roughly $1.8 trillion, 3.5 times the upper bound of fraud. Fighting fraud requires significant administrative spending. It's not a switch you flip to balance the books. Even if every lost dollar were recovered, a deficit north of $1.3 trillion would remain. With mandatory spending on Social Security and Medicare exceeding 60% of the budget, fraud enforcement doesn't touch the core structure. Trump's pledge to leave those programs untouched means anti-fraud measures and workforce cuts alone cannot possibly solve the deficit and debt problem. All three proposals share a triple-layer collision with reality. On fiscal scale, tariffs plus maximum fraud recovery might scrape together $1 trillion, far short of the $2.5 trillion income tax hole and the $1.8 trillion deficit. They can't simultaneously fund tax cuts and balance the budget. On market logic, the housing plan ignores supply-demand pricing. Tariffs defy trade and pass-through economics. Fraud enforcement misunderstands fiscal arithmetic. None would survive market verification. On political economy, the policies play to voter sentiment, but the costs, higher consumer prices from tariffs, unresolved housing tensions, and untouched structural deficits, are borne by everyone. In sum, Trump's three economic pillars are a political narrative designed to mask deep fiscal and economic contradictions. If implemented, they would fuel inflation, escalate trade friction, and chill business investment, deepening the disconnect between Wall Street and Main Street. Far from solving the core issues of high deficits and debt, they risk making America's fiscal sustainability problem even worse.